Here's a question worth sitting with for a second. What if having a healthy bank balance is actually costing you money? It sounds backwards, it sounds wrong. Surely more money sitting in the bank is a good thing, right? But the data tells a very different story, and it's one that's quietly draining wealth from millions of everyday Australians without them even realizing it. Most people in Australia operate with two main accounts. There's the everyday transaction account, the one wages land in, the one bills get paid from, sitting there earning next to nothing, often a flat 0%. And then there's the savings account, the one that's supposed to earn interest, supposed to build wealth over time. Here's the problem. Survey data from Australian banking institutions has consistently shown that a significant share of Australians, often cited at around a third, keep the bulk of their savings sitting in the wrong account entirely, either parked in low-interest transaction accounts or in savings accounts that aren't actually competitive. And that single mistake is quietly costing people thousands of dollars over time. So let's break down exactly why this happens, and more importantly, what the fix actually looks like. The first reason is purely psychological, and it's sneaky. When people see a large number sitting in their bank account, something shifts in the brain. A big balance creates a false sense of affordability. It feels like permission to spend. Behavioral finance researchers have long pointed to this exact pattern. The bigger the visible balance, the easier it becomes to justify that extra dinner out, that impulse purchase, that "I deserve this" splurge. The fix here isn't complicated, but it does require discipline. Financial counselors and money coaches frequently recommend physically separating spending money from savings, ideally even using a different bank altogether for savings, so it's not sitting right there, one tap away, tempting you every time you open the app. Out of sight genuinely does mean out of mind. Now here's where things get more mathematical and more painful. Reason number 2, inflation. Cash that just sits there, untouched, isn't neutral. It's losing value every single year. The Reserve Bank of Australia targets inflation in a band of 2 to 3% annually, and even when actual inflation tracks below or above that target in any given year, the long-run effect is the same. The dollar buying power of idle cash steadily erodes. Think about it this way. $10,000 sitting in a near-zero transaction account today will still look like $10,000 in 10 years. The number on the screen won't change. But what that $10,000 can actually buy, groceries, fuel, rent, a holiday, will have shrunk substantially. That's the silent tax inflation places on money that isn't working. Reason 3 follows directly from this: lost interest income. And the gap here is bigger than most people expect. A standard transaction account paying close to 0% interest compared against a competitive high-interest savings account, and in Australia's current market, some providers have offered ongoing or introductory rates well above 4% annually, creates a real measurable dollar difference. Over 1 year, on a meaningful balance, that gap might only look like a few $100s. Annoying, but survivable. Stretch that out over 10 years, and compounding takes over. The difference between earning near zero and earning a competitive rate, compounded annually, can mean the difference of thousands of dollars in pure, painless, completely passive income. Money that required zero extra effort, just sitting in the right account instead of the wrong one. But reason 4. Reason 4 is where the real opportunity cost lives. Because savings accounts, even the best ones, are still just the first rung of the ladder. Consider 3 paths for the exact same starting amount of money, held for a decade. Path 1, parked in a transaction account earning almost nothing. Path 2, sitting in a high-interest savings account, compounding steadily. Path 3, invested in the share market. Historically, Australian and global share markets have delivered average annual returns across long time horizons and accounting for both growth and dividends that have outpaced savings account interest rates over extended periods, though of course returns are never guaranteed and markets do experience volatility and downturns along the way. Over a 10-year stretch, the gap between those three paths can become enormous. We're not talking about a marginal difference anymore. We're talking about a completely different financial outcome, built entirely on where that same starting dollar was allowed to live and grow. So if leaving cash idle is the problem, where should money actually sit? Start with the transaction account. Financial advisors generally suggest this account should hold roughly 1 to 2 weeks of float, just enough to cover immediate bills and day-to-day spending. Not a buffer, not a stockpile, just enough to keep things moving. Beyond that, the conversation splits into two main vehicles: high-interest savings accounts and, for those with a mortgage, offset accounts. These serve different purposes and come with different tax treatment. Interest earned in a standard savings account is taxable income and must be declared at tax time. An offset account, by contrast, doesn't generate taxable interest at all. Instead, the balance sitting in it reduces the interest charged on a linked home loan, which can be a significantly more tax-effective strategy for many mortgage holders, particularly those on higher marginal tax rates. Fees, account access, and minimum balance requirements vary by lender, so comparing actual terms matters more than chasing a headline rate. Beyond the choice between savings and offset, there's a broader framework worth understanding, often called the bucket system. It's simple, but it's powerful. Bucket 1 is the emergency fund. The widely recommended target sits between 3 and 6 months of essential living expenses, held somewhere safe and immediately accessible, not invested, not locked away, just there for the moment life throws a curveball. Job loss, medical bills, urgent repairs. This bucket exists purely for protection. Bucket 2 covers short to medium-term goals, anything with a time horizon of roughly 1 to 5 years, a house deposit, a wedding, a car upgrade. This money generally shouldn't be exposed to share market volatility because there simply isn't enough time to recover from a downturn if the market dips right when the money's needed. High-interest savings or term deposits tend to suit this bucket far better. And bucket 3 is for long-term wealth building, anything with a horizon of 5 years or more. This is where investing becomes genuinely powerful because time becomes the great equalizer against market volatility. The longer the horizon, the more historical data supports riding out short-term dips in favor of long-term compounding growth. Before wrapping up, it's worth being clear about something important. This video is general educational content only. It does not constitute personal financial advice, and it doesn't account for individual circumstances, goals, or risk tolerance. Anyone making decisions about savings, debt, or investing should consider speaking with a licensed financial advisor or using resources like the Money Smart website, run by Australia's corporate regulator, to get guidance tailored to their own situation. So, here's the real takeaway. A big bank balance feels safe. It feels responsible. But money that's just sitting there, untouched, isn't actually safe at all. It's quietly losing value every single year, while better options sit just one click away. The goal isn't to keep more in the bank account. It's to keep exactly what's needed there and put everything else to work. If this broke down something useful, drop a comment with the account split that's worked for you. Hit subscribe for more breakdowns on Australian money, investing, and the systems that actually build wealth over time. And check the links below for related videos on offset accounts, emergency funds, and how to start investing with confidence.